There are levels to real estate investing, and the further you go, the less of your own money you actually need to use. And what I'm going to show you in this video is how to go from beginner to billionaire real estate investor. Now, this isn't going to be just theory. These are the exact stages I've seen the most successful real estate investors go through, and I'll show you exactly how to figure out where you're at, what's holding you back, and what your next move needs to be. Level one, you learn to stop spending everything you make. Look, this is where the game actually starts right here, because if you can't say no to short term pleasure, you're never going to build long term wealth. Look, rich people aren't rich because they make more, they're rich because they keep more. I can't tell you how many people I've met that make $500,000 or $1 million a year and tell me that they want to write a check and invest in my next deal. But we sit down, we look at where they're at, and it turns out that, yeah, they could squeeze out a $50,000 investment, but because they spend so much money every month, every year, that I say no, because that $50,000 is the only cash that they possibly have. There's tons of people around that are flashing the high-end cars, the high-end lifestyle, the high-end everything, the watches, the clothes. But the truth is, if you actually look at their balance sheet and you look at their financial statements, there's no assets, tons of liabilities. And if that person stops going to work or stops doing what they're doing, the entire house of cards comes down. So look, the first step, depending on if you're even if you're making 20,000 a year or $250,000 a year, is have you developed the muscle to be able to not spend everything that comes in? I'll give you an example. I'll never forget when I was 12 or 13 years old and I had a job at a golf course at a driving range, and you're picking up golf balls before they had the pickers driving around, us kids running out there with hockey sticks and milk crates, and we would, shuffle all the balls towards the middle and then put them in the milk crates, and every crate was $2. I would roll up on my bike to this golf course or to this driving range, and I'd have my crates set up. I remember I had four in one hand, four in the other, so 8 crates times two, that's $16. Plus, I'd probably run back and forth, and my goal is to make $20. Okay. And I did this 2, 3, 4 nights a week. It was good exercise. I'd go in there when the lights were dark and, just before bedtime, make like $20 an hour, but you're just like working. That would be like a workout. At that point, I hadn't really developed any muscles for setting money aside. So I'd be bringing in like 60 or $80 a week, which at that time was like $1 billion for a 12 or 13-year-old kid. And what happened? I had no financial discipline. So every week the money was gone. I'd start buying snacks. I bought a new bike. The money just was gone. And I remember after doing this for about 2 or 3 months, I realized that I was exactly where I was before, and now I had the liability of going to this golf course to keep paying for this lifestyle that I no longer really appreciated because it just became normal. The idea of buying snacks for myself and my friends became normal. I was riding my bike home one night, and I'm like, "Why am I doing this? Like, why am I riding my bike 40 minutes each way to go pick up these golf balls so that I can do this, so I can then go back to school and then buy juice boxes?" Or like, it was a funny moment at a really young age, but I remember when I hit that moment, it was insane. So what did I do? Well, I decided that I would take half the money and I would just put it in the bank. And then I started cutting back on the juice boxes and on the pizza and just the stuff that 12, 13-year-old kids just kind of blow their money on. And then after a few weeks, I remember I went to the bank to deposit a little bit more money. So I hit print and I looked at the receipt, and I remember I saw like $453. And I'm like, wow, like getting the idea to stop spending all that money at that early age was such a big lesson for me, and I really appreciate that I internalized it that early in life. On the other side, I'll give you an example. I have a client, investor friend of mine, we'll call him John. John runs a $20 million a year business. He works in, let's just say, construction, and his business generates over $20 million a year in revenue. He probably takes home $4 or $5 million. His car, $10,000. His clothes, he looks like he just got out of the gym. Every time we hang out, it looks like he just got out of the gym. He is literally the definition of don't judge a book by its cover. See, he doesn't spend any money on new cars or flashy clothes or any of this stuff because he doesn't value those things. And because he doesn't value those things, he doesn't feel compelled to buy them. But I can tell you, I've done a few deals with him. He brings in $4 or $5 million a year. On the street, you would never know, you would never tell. I remember talking to him back then, and when he was making, maybe paying himself a couple $1,000s a month, the habit of putting money aside, planning for the future, that was number one. And because that habit compounded over the last 10 plus years that I've known him, all of those good habits have compounded into other things that are in this video. Level two, you build the habit of contributing to something. And look, it doesn't matter if it's a savings account or something else. The skill here is discipline, moving money to a place where you don't touch it. This sets the foundation for every big move that you do after. Now, look, I'm not trying to be some kind of financial guru where I tell you to put your money into savings or stocks or real estate or anything else. But the point is, the habit, the mental muscle of knowing that when you have $100, $1,000, or $10,000 coming in, that a certain percentage of that money is set aside for investing. At this stage, I remember having a little bit of money in the bank, and I met a real estate agent, and I thought this guy really had it all figured out. I mean, he had the nice car, he had the lifestyle, he had multiple cars, just really living life. So I was like, well, what are you investing in? And he told me he invested in real estate. So I was like, well, I want to do that. So this is literally, I think it was in my late teens. I'd read Rich Dad Poor Dad by then. I started looking for mentors and things like this. And I remember me and my best friend at the time, we both had a couple grand in the bank, or was it 10 or $20,000, and we went out and we actually bought our first house. So the fact that we had some money set aside put us in a position where we'd actually buy our first property and learn how to invest in real estate. Now, the story behind that property, I'll tell it another day. But the point is, because we'd already had some savings set aside, we actually had the ability to buy this first property super early in life. Level three. So you start to work on other people's projects for experience and fees. Look, working on other people's projects and maybe having some of your own skin in the game is great because you have the exposure. You don't really have any ownership yet, but you're gaining the reps. And that's where you start to build trust, a track record, and real world knowledge. Some of my early wins getting exposure to real estate before I finally bought my own deal was there was a real estate agent in town that I got to know. He was successful. He had a lot of agents working under him. They were doing tons of business. They had huge billboards, big advertising. So naturally, in my late teens or mid teens, I thought real estate agents knew everything about real estate. So I thought, okay, I'm going to learn from this guy. And, I'm glad I did because I didn't have a way to add value other than just my own labor. So what I did is I volunteered to work for free. And the only thing I could do for them that was of any value was pick up and drop off the for sale signs. So I had a beat up old 1984 Golf Jetta or Volkswagen Jetta. And I remember trying to cram the for sale signs in the trunk. I'd tear up the roof liner and everything else. But I didn't care because I'd go pick up the signs, drop them off. When I was on site, sometimes dropping things off, picking things up, I'd get to talk to contractors that were maybe doing renos, whatever it was. And it was a really cool way for me to get some exposure, not really have any risk. But also, whenever I'd come into the office, they'd also have mortgage brokers or property managers around, and just listening to them having conversations, negotiations. Everybody got used to seeing me in the office. So eventually, what ended up happening was they all kind of be rooting for me and teaching me stuff and taking me aside. And that's actually what took me to the next level, which is level four, which is you do your own projects with your own money. Now, look, for some of you, maybe it was your first flip or your first fix or buy and hold or whatever it is. And you've kind of figured out how some of the pieces work and, the capital that you're risking is yours. And, most people that get into real estate investing kind of plateau at this level. And for me, my first deal was, again, I was spending so much time at this real estate brokerage that the real estate agents and the brokers and the financial people and all the people were just kind of trying to talk me into doing my first deal. And I ended up doing my first deal and they walked me through it. They helped me find the property manager, the mortgage broker, the lawyer, the accountant to help me with the books. And yeah, I think was I 19 or 20 years old at the time. And, as I'm going through the process, I'm figuring out down payments, all the different things that are involved. It's kind of like a mini business, right? Doing your own first deal. For a lot of people, it kind of becomes your first exposure to that world. And it was for me. So I remember it was ended up being me and my best friend and I, we ended up doing this first deal together. We ended up buying this house renting it out, renovating it. There's a whole story there, but we learned what negative cash flow was because we didn't underwrite it properly, but that's another story altogether. But the point is, I'm glad we did that deal. We ended up actually, the tenants ended up leaving. We ended up fixing the property, flipping it. We ended up making a good amount of money at the time. And for me, that was the first experience in kind of like running your own first real estate portfolio. Now, if that's all you get out of investing in real estate is doing your own deals once in a while, putting together a rental property or to fix and flip or whatever it is, congratulations. You're ahead of 99% of people out there. In my experience, few people end up going past level 4 doing their projects. The reason for it is because level 4 is simple. It's your own money, it's your own deal, it's your own process. It's kind of everything is on your own. But the real scale and the real leverage in real estate is level 5, where you start to get involved in other people's deals. You may co invest with other people, you put in some money, you put in some time, you're getting involved in transactions that you wouldn't do on your own. So the downside is you're not in charge, you're not leading the deal, but now you're starting to see real leverage and you're starting to learn how capital starts to move in a much bigger group setting. For me, level 5 started when I got recruited by a private equity firm. I was in my early 20s now, and the firm that I was working at, we were raising capital for Ken McElroy of MC Companies. Now, back then, back in 08, 09, if you guys remember, the whole world was on fire. Everything had just crashed. So when I started working at that firm, we had the good fortune of raising capital for MC Companies, which was fantastic because although I was able to put my own money into these deals, there was no way that I could have done these types of deals on my own. You're talking about hundreds of units, tens of millions of dollars in down payments, tens of millions of dollars in debt. These were at the time for me going from doing single family to looking maybe at a duplex or a fourplex to now transacting or buying 150 to 250 units or working with Ross, Ken's partner, on developing 200 to 300 unit buildings. These for me were just mind blowing experiences. But I'm glad I made that jump and gave up control over having to do my own little deals, buying one house at a time, because I ended up in the fast lane. I literally went from doing one house, two houses at a time to seeing how entire communities were developed, built, acquired, sold. In my early 20s, this was a fantastic opportunity. I got to see how deals were structured. I got to see how capital stacks came together. I got to see how the institutional and the retail investors work together. There were so many different aspects of deal making that I was exposed to in my early 20s. It was literally like drinking from a fire hose. I started to understand the nuances between brokers and dealers and capital raising entities and debt providers and property management companies, and just seeing things operate on a much larger scale, even seeing the financial statements. I remember in my early 20s, I thought I knew how to read a financial statement. I would look at my own financial statement of here's how much I made, here's how much I spent, here's what's left, to my first rental property, to a very simple income line, to an expense line, to what I've got left over. And I didn't know it at the time, but I was doing something called cash accounting. To when you're working in private equity, you now have accrual based accounting, you have audited financial statements, you have offering disclosure documents, you have securities laws that govern how people are allowed to invest, who's allowed to invest, disclosure items, risk acknowledgments. There were so many different words. I can't tell you guys. I remember sitting in meetings for the first 6 months when I first got hired to I remember I was just sitting there, and I don't know if you guys are old enough to remember this, but before ChatGPT and even Google search and all this stuff, there used to be this online service called Ask Jeeves. And Ask Jeeves was like a Yahoo or a Google. And I remember Jeeves was my best friend because I'd be asking Jeeves everything because there were words they were using in meetings. I'd be writing them down and then going home at night or on my laptop, and I'd be asking Jeeves, what is an offering memorandum? What is risk mitigation? What is due diligence? Like, what is a data room? Like, what are all of these things? So for me, level 5 was a game changer because when I got involved in other people's deals that had bigger vision and bigger goals and had already been to the top of the mountain, that single-handedly changed my entire outlook on how I operate today. Level 6, you start to do your own deals with other people's money. Now you're in control of the strategy and the execution. People are trusting you with capital because you've built a track record and a team. And this is where most high level operators live. You're in the game for real now. So, for context, after raising 300 million plus with MC companies at the firm that I was at, I decided to leave and go out on my own. Based on the team, the reputation, the people I'd met, the results I was able to generate, the understanding I had of the capital markets, all the different components that came together after a couple years of just slugging it out and working for the knowledge and the context and the information and the contacts and just building my personal credibility in the marketplace. When I left and I built my first fund, it was an 8-figure equity fund, and I put the team, the partners, the opportunity together. I was only able to do all of those things because I built the relationships, built the track record, built the credibility of somebody that could make things happen because of, well, the evidence and the proof of all the effort that I'd put in before to work on other people's stuff. So, for those of you who don't know, in 2010, 2011, we launched, well, part of my team and I, we launched our first 8-figure equity fund. We were buying medical plazas and dental plazas in Arizona at the time. So, 2010, 2011, if you guys remember, the world was still on fire. Investors were not there. So remember, '08, the market crashed. Everything was upside down. So 10, 11, it wasn't maybe till 2012 that things started to turn around. So in 2010, 2011, when we were buying, there were no buyers. Debt was incredibly difficult to get. So in other words, most of you guys have probably never lived through an environment like this, but can you imagine going to lenders and them saying, yeah, we're not lending right now, like just at all? Like, what do you mean? Like lower loan to value, higher interest rate? No, 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 we're just not lending. And that was the state of the market. There was very little money in the system. So if you showed up and you wanted to buy anything, you had to pay cash. So that's what we did. We put together an 8-figure equity fund. We raised a bunch of cash and we came down and we started buying buildings for cash. Now, back then, the values were super depressed because there was no debt. If you had to buy cash, cash offers were much lower than if debt was available. So we were buying buildings for 20, 30, 40 cents on the dollar. This opportunity that I'm describing to you was only available to me in hindsight because I put in the work and I put in the effort of the level before. Level 7, you no longer need to invest your own money. At this point, you are the opportunity. Look, people are going to invest with you, not just because of the deal, but because it's with you. You're literally operating at the MC companies level, the Elon Musk level, the Warren Buffett level, or the institutional capital level where capital will flow to you because your name is tied to a deal. Once you develop, we call this your unfair advantage. Once you've fully flushed out and developed your unfair advantage, and you've got the proof and the receipts and the effort and the track record, whether it's internally or borrowed through other people, you eventually get to a level where your capital involvement in a deal is optional because people trust you. Now, obviously, to maintain that reputation, you have to maintain the quality, the standards, you have to maintain the performance that people have come to expect of you over the last 5, 10, or 20 plus years. But ultimately, capital at level 7 flows to your name. And the project is just the legal entity that people are investing into. But that project could have been any other project out there. Take, for example, Elon Musk. Today, how many companies does he have running? Ultimately, there are tons of people out there, retail and institutional investors, and it doesn't matter what his next venture or project is because they've made money with him, they've seen how he operates, they know, like, and trust him and feel like they've got a good handle of who he is. They're willing to fund whatever projects he wants to do next. So listen, if you like this content and you're a real estate investor, operator, fund manager, capital raiser, somebody who's serious about scaling their business, make sure you hit that subscribe button to get all of my content.